Hello there and welcome to this week's casual video that is inspired by the emails I've received when it comes to companies with low price to book ratios. And oftentimes these emails end up with a question in the form of what am I missing or does this even make sense? Now we're going to take a look at the theory because the theory is quite simple. If the price to book ratio is 1, it means that the stock price is trading in line with the book value of the company. What is the book value? It is all the assets minus all the liabilities. If the price to book ratio is below 1, usually it is considered a solid investment. I'm going to argue that that is the case, especially with the example that follows. And it could mean that the stock is undervalued and worth buying. Now, it could mean, I'm not saying that it never is, of course, it could mean, but using solely price to book ratio to make any investment decision, I'll argue that that is quite a bad idea. On the other side, if the price to book ratio is greater than 1, so you're paying more in cash than what you're getting in terms of assets and liabilities, you're paying a premium to the company's book value. It could also indicate that you're overpaying, but if you take a look at any tech company, the price to book ratio is going to be a lot above 1. So using book value as such is not really a great idea when it comes to tech companies because it doesn't really represent even close to what the value of the business is. It could be higher, it could be lower, but if you take a look at Meta, for example, or if you take a look at Apple, the price to book ratios are going to be a lot higher than the 1. So in theory, if you have a company that has a price to book ratio below 1, because again, this video was inspired by those emails, you get more than what you pay for in accounting terms. And that in accounting terms is where the catch is. Now, the theory is simple, but the reality is not so simple. So let me introduce you to Big Lots. It's a furniture and home decor retailer. And the first thing that we're going to do is calculate the price to book ratio. If you take a look at the market cap, this is a company with a market cap of slightly above 210 million. So if you want to buy all of the company, likely you'll have to offer a premium. So let's assume that you have the option to buy the entire company, but you have to pay 250 million. So pay the premium, and what you get in terms of book value, take all the assets minus all the liabilities, is your equity of 500 and let's round it to 550 million. So that leaves us with a price to book ratio of below 0.5. So can you not buy the entire business for 250 million? That's the market cap, including the premium, and just sell it for 550 million. What that means is you'd have to sell all the assets, cover all the liabilities, and you would be you have 550 million left for yourself, right? That is the theory, because there are two strategies that evolve around low price to book ratio. The first one is to buy the company and sell its different pieces, which is pretty much what I've just explained, or to run the business better than the current management, use the assets better than they're using, and generate significant cash flows. Now, if you opt for the first option, which is to buy the company, 250 million, and sell it for 550 million, you are assuming that the book value is equal to the liquidation value, which is not the case. But let's continue with this example. Imagine that you did pay 250 million, and now you own the company. Now, what are your next steps? You can pause the video and you can try to think of a strategy how to get rid of these assets, by the way. Because the liabilities, that's not the part that you're worried about. I mean, the liabilities, well, they're not going anywhere. But first you have to convert all the assets into cash, right? Or most of them. And there is also something that is missing here, but we're going to come back to that later on. Now, if you take a look on the asset side, there are 3 different buckets that are really significant in nature. You have inventories of 1.1 billion that you have to get rid of. You have operating lease right of use assets. So these are lease contracts that you have signed, or the company or the previous management has signed, whether that is related to renting space, for example, or certain equipment or vehicles. They're valid for 3, 4, 5, 6, 7 years. So you have to figure out a way how to cancel those, because obviously on the other side, you have the lease liabilities. There's the current portion and then there's the non-current portion. And then you have property and equipment, where the book value net is roughly 750 million. Now we're going to take a look at all of these 3 buckets one by one, starting with inventory. So we have 1.1 billion. The first option that we have is, well, we have all of these stores, we have all the employees. Let's just use what we have and just get rid of the inventories through that channel, right? If that is the case, we keep the business up and running, but take a look at the profitability of the business over the last quarter. The company cost of sales, so this is basically the inventory becomes the cost of sales. So 730 million of inventories for one quarter. It earned in revenue 1.1 billion, but after covering all of the operating expenses, it actually lost quite a bit of money. It's over 200 million. So if we take this route to sell the inventory through business, basically it would take us time to even get the cash, but in fact, we're making a loss on this because we have to keep paying the leases, we have to keep paying all the employees. And also think about how this would look like in reality. You have a 100% full store, then it becomes 80% full with inventory, then it becomes 60%, and it becomes 40, 30%, but you'll never get it down to zero. So you're likely going to have to offer quite some discounts to get rid of all of this. Now, there is another option. We could call one of the competitors and just offer if they would like to get the 1.1 billion of inventory. And you can do that. You could give them a call, and likely the answer that you get from the other side is absolutely, we're going to pay you 500 million for it. Now, you might wonder, well, wait a second, the book value is 1.1 billion. Yes, the book value is 1.1 billion. That is how much Big Lots paid for all the inventory to the manufacturing companies to get the inventory into their, for example, stores and warehouses. But our competitor can do exactly the same thing. They could also make this order directly from the manufacturers, and they don't have to make an order for 1.1 billion because they're not going to need that much inventory right away. They could order, for example, 200 million, and then the next quarter another 200 million, which is anyway what they're doing at the moment. So if you own this company with 1.1 billion, you have zero negotiation power. On the other side, the competitor, well, they have all the power because they don't have to buy this inventory. There is no need for them to tie 1.1 billion in capital in inventory that will not do anything for the next quarter or two. So likely, if you want to go with the second option, you're going to have to sell it at a discount, which means the 1.1 billion might become 500 million, maybe 600 million, maybe 700 million, but you can already see that there's quite a bit of discrepancy between the book value and the liquidation value. But this is only one of the three buckets that we had on the balance sheet. What about the lease agreements? You could for sure cancel them, but you have to take a look at the cancellation policy. And likely you're going to have to pay certain fees, certain penalties in order to cancel these lease agreements, because there is no way that you can just call whoever is on the other side and say, hey, as of tomorrow, we're not going to lease anything. It's just not happening, right? And then there's a third bucket, which is land, buildings, all the equipment, vehicles that you own. Now, the land and buildings, the ones that the company owns, are not that difficult to sell, at least in theory, right? In practice, in today's market, I see a lot of real estate transactions being done quite easy. So let's assume that that's easier to sell, that you can get the book value. But what about all the equipment that you have? And by that, I mean the stalls, the cash register, something as tiny as that, all the way to your forklifts, to the delivery vehicles. You're going to have to sell those at discount as well. So if we go back to the balance sheet, it's quite clear that you cannot get as much in cash as what is on the balance sheet. But what else is missing? Well, how about the employees? You cannot just fire everyone without paying some sort of severance pay. So everything that's on the balance sheet is not really representing the value of the business if you are going to liquidate it. So why is this the case? Does it mean that the balance sheet is not correct? No, that is not correct. There is something called going concern that you need to be aware of. It is a fundamental assumption that the company will remain operating into the foreseeable future rather than undergo a liquidation. Therefore, the financial statements have been prepared on a going concern basis. What it means is, this is the value that the company gets from these assets if it is operating, not if it's going to liquidate it. So this is a very simple example, but I hope that you found it useful and At least the next time that you look into a company that has a low book price to book ratio, you can try to take a look at the assets and try to figure out, is it easy to really dispose those this easily? Because if that's not the case, then well, and by the way, I'm not saying that big lots is a good or a bad investment. I don't know if it is. I have not done enough research when it comes to really analyzing the fundamentals of the business and assumptions about the future. So I cannot answer that question. It could be, there are a lot of scenarios that could happen. Even though it is making losses, made losses over the last quarter, there's always a chance that that turns around. There's always a chance that the company gets acquired. There's a lot of different scenarios that can play. But the purpose of this video is just to show that using the price to book ratio as a standalone number might not be the best idea. And think about it this way. If all you had here was cash for 3.7 billion, well, there the conclusion would have been much easier to make. You could buy all the company, assuming that the shareholders on the other side are willing to sell, which you would already question, would they be able to sell? Would they accept the premium of 20%? Probably not, right? So you would likely not be able to buy the entire company in the first place. But what if, for example, you have goodwill of 1 billion? You cannot sell it. So it is an accounting number. It exists there, but you can never sell goodwill. You cannot get anything in return. So keep this in mind the next time you look into a low price to book ratio company. I hope that you enjoyed this video, and as always, see you in the next one.